Okay, so you're a business owner in California and you're thinking about selling. You've probably been laser focused on one thing, that big headline price. But I'm here to tell you that number isn't the whole story. It's not even close. Today, we're going to run through the practical checklist that determines what you actually walk away with. Let's dive in. If there is one thing you take away from this, it's this. Structure is greater than price, always. How you structure the deal, whether you sell your company's stock or its assets, is going to have a much bigger impact on the cash in your pocket than the offer price itself. It's everything. It dictates your tax bill, what liabilities you're left with, and honestly, whether the closing is smooth or a total nightmare. All right, let's make this really concrete. Imagine a buyer puts a $10 million offer on the table. It's a fantastic, life-changing number, right? But here's the kicker. Depending on how that deal is structured, the actual cash that hits your bank account can swing by hundreds of thousands of dollars. We're going to use this exact $10 million scenario to see how it plays out. Look, your decision really boils down to two fundamental things: tax and risk. Seriously, every other detail flows from how you and the buyer decide to handle these two issues. And you've got to know, buyers and sellers almost always want the exact opposite thing here. Bridging that gap, that's where the real deal-making happens. So first, let's talk tax. In a stock sale, things are pretty straightforward. Your profit is typically treated as a capital gain. Simple. But an asset sale? Oh, that's where it gets complicated. Part of your gain can be recaptured and taxed as ordinary income. So, for example, all that depreciation you've taken on your equipment over the years, that gets taxed at much higher ordinary income rates. If you're a manufacturer or any business with a lot of machinery, this is a huge, huge deal. And here is the classic California curveball. Unlike the federal system, California taxes long-term capital gains at the same rate as ordinary income. So you might be thinking, well, who cares then? If the rate's the same, what's the difference? Well, you should care. A lot. It's all about how the purchase price gets allocated among the assets. In an asset sale, the buyer wants to put as much money as possible onto things they can depreciate fast, like equipment. But every dollar they allocate there directly increases your ordinary income recapture, which can jack up your total tax bill. Next up, risk. In an asset sale, bam, you can get hit with California sales tax on all your tangible assets, equipment, inventory, you name it. That's a direct shot to your proceeds. The flip side is, the buyer only takes on the specific liabilities they agree to in the contract. Now, with a stock sale, you dodge that sales tax bullet, which is great. But the buyer inherits the entire legal history of your company, every single known and, more importantly, unknown liability. You can see why buyers usually push hard for asset deals.
And you know, while we're talking about hidden costs, you have got to watch out for the working capital peg. This sounds super technical, but let me tell you what it really is. It's a last-minute price cut in disguise. It's the amount of operating cash the buyer says you have to leave behind for them. If they set that target way too high, it's not a negotiation point. It's them forcing you to leave your own cash on the table, and it comes straight out of your final check.
So you've got this standoff, right? Buyers want asset deals for the tax write-offs, and sellers want stock deals to avoid the tax headaches and liability issues. How on earth do you get a deal done? Well, there's a third way, a sophisticated hybrid option that, if you play your cards right, can give both sides what they want.
This is where we get into some really powerful tax code stuff. These elections, like the 33H, H10, are basically a tool that lets you have your cake and eat it too. They allow you to structure the deal legally as a clean stock sale, but then for tax purposes only, everybody gets to pretend it was an asset sale. This gives the buyer that huge depreciation benefit that they're after.
But, and this is absolutely crucial, you do not just give this away for free. Making this election for the buyer is almost certainly going to increase your personal tax bill. So, what do? You trade it. You tell the buyer, sure, I'll do this for you, but you have to add enough money to the purchase price to cover my extra tax hit. That's the gross-up negotiation, and it's a deal point you have to win.
So how does this actually work? Well, it's pretty straightforward. First, you and the buyer agree on the whole concept and, most importantly, the gross-up amount. Then you file the right paperwork with the IRS. You end up paying taxes as if it were an asset sale, and in return, the buyer gets what's called a step up in the basis of the assets. That means huge future tax savings for them. It can be a win-win, but only if you negotiate it properly. Okay, enough of the theory. Let's get back to our $10 million offer. How do these three different structures, the stock sale, the asset sale, and the deemed asset sale, actually play out on the spreadsheet? Let's look at the numbers. All right, take a look at this. The bar on the far left, the stock sale, that's often your best case scenario as a seller. The gain is mostly capital, no sales tax, you keep the most. Now look at that middle bar. Ouch. That's the straight asset sale. It's lower because you got hit with both that ordinary income recapture and a big chunk for California sales tax. But then, look at that third bar, the deemed sale. That shows you the power of negotiating that gross up. If you do it right, you can bring your net proceeds right back up to where they were in the stock sale. So let me just say this again because it is so important. We are looking at the exact same $10 million headline price. But the difference between the best structure and the worst structure could easily be hundreds of thousands of dollars in your pocket. This is not pocket change. This is why structure is king. But what happens when the financial models are pretty close? What if your CPA runs all the numbers, and after all the math, the different scenarios look pretty similar? Well, that's when we have to step away from the spreadsheet and think about the real world of actually running the business. When the money's a toss-up, the structure that guarantees the smoothest possible transition wins, period. Because interrupting your revenue stream or losing customers because of a messy handover can destroy value way faster than any tax savings can create it. You just can't put a price on a clean, continuous operation. Think about it. An asset sale means you are legally transferring every single thing the business owns and needs to operate. So you have to ask yourself, which of our government licenses require a whole new application? Which of our key customer contracts have clauses that say we can't just assign them to a new owner? A stock sale often just sidesteps all of this friction because the legal company, the entity itself, doesn't change. And that's a massive, massive advantage in highly regulated industries like healthcare, construction, or trucking. So, how do you manage this operational risk? You get way out in front of it. Before a deal even gets serious, you do a full audit of every single one of your critical licenses and contracts. You identify every approval you're going to need, you build a detailed transition plan, and most importantly, you make sure your lawyer writes those key approvals directly into the purchase agreement as a non-negotiable condition to closing the deal. Okay, this all leads us to the final, and frankly, the most critical part of this entire checklist. All of this analysis, all these decisions, they're completely worthless if you make them at the wrong time. And the right time is right now, before you've agreed to anything in writing. Let me be absolutely crystal clear here. The second you sign a letter of intent, an LOI, it is basically game over for negotiating deal structure. All of your leverage on this point just evaporates. Trying to change from an asset sale to a stock sale after that LOI is signed, forget about it. It's almost impossible. You have to nail this down on the front end. So here is your action plan. Step 1, your CPA needs to build what's called a seller net bridge, modeling your after-tax cash for all three of these scenarios. Step 2, your tax attorney has to confirm your company is even eligible for an election like the 338H10 in the first place. And finally, step 3, armed with all that data, your M&A advisor can go negotiate the optimal structure into the letter of intent from day 1. So as you get ready for what is probably the biggest financial event of your life, the question isn't just, what's the price? The real question you have to ask yourself is this: is the structure outlined in your letter of intent designed to protect your final check, or is it designed to protect the buyers? You better have the answer to that question before you even think about picking up a pen to sign.